I've been working day and night. And I just really felt the urge once it was happening, that I needed to get out there more, because with COVID happening, I just realized so many people are uneducated in every arena of their finances. And it was sickening to me, whether it was through ignorance or just the information not being out there, or too much information being out and not really knowing how to apply it to them. So I do want to thank the ladies, Denisha, Michelle, Britt, for, putting this initiative together, because it's needed, it's wanted, it's necessary. I thank you all for coming out. Those of you who I know, I'm sad that I wasn't able to see you this year, but we were still able to make it work. And those that I don't know, I'm hoping you'll get something from this today. Just if you can just take one thing, I'm happy. Michelle was nice enough to say that you're going to get a whole lot. I'm not sure how much you'll get from it. A lot of the information I'm going to go over today is real general information, just to give people ideas on things that they could do, just because when you're talking about taxes, it's just so individual. And so the plans and strategies that we put in place for our clients are for them and them only. And so again, I'll give some details and changes that are going to happen for 2021 going forward, but then I want to talk to everyone about how they could just amp up their finances and how to make more money without paying taxes, if that makes sense. Britt, can you pull the slide up? You can do the, go to the second slide, please. So some topics that we're going to talk about today are just the changes that are going to take place for 2021 tax season. So when you go in to file your 2020 tax returns, just going to give you some helpful tips that you can look out for, things that you can just start to put in place now so that they'll be effective for this year before the year ends, which are going to include waived RMDs, which if someone don't know, the required minimum distributions, higher standard deductions, a charitable deduction that is now available to everyone, higher income brackets, higher contribution limits for some retirement accounts, not all, higher contribution limits for HSAs, higher income limits for the Savers Credit, and more valuable earned income tax credit that I like and don't like, higher cap on Social Security payroll taxes, which I do not like at all. But then the last, we're going to talk about how we can start a business, see if there's things that you may be doing as a hobby that you can monetize on, because that's really how you're going to build wealth and build generational wealth. Britt, you can change the slide, please. Okay, so for the RMDs this year, this is going to work for if you are someone who's retired. When you retire, because you put money into your retirement account, and it's pre-tax, meaning you haven't paid taxes on it, once you hit a certain age limit, the government kind of forces you to take a minimum amount. And like Michelle said, before I get too much into it, I'm not going to really get into the whole actual mutual funds or retirement accounts and allocations. You can do that separately, but I still want you to know how they affect your tax piece. So I'll be only referencing how it would affect your income taxes.
Right.
the required minimum distribution, the government says once you hit 70 and a half, hey, we want some money. We allowed you to not pay taxes on it for this amount of time. Now we want it. So they'll force you to do that. The good thing with 2020, they're not going to force people to do that, which for some, if they don't need the money, that's really good, because that will keep their income a little bit lower than it normally is, which will allow them to save on taxes. You can go to the next, please. The second thing that is really good to know, the higher standard deductions. So when we calculate how much tax you are to pay, they go by your filing status, which is married filing joint, married individuals filing separately. So if you do have a spouse, but you don't want to file with them, that's the married filing separately. You have head of household, which could be a single person, but that person has a dependent, has a child, has maybe a child, even an adult child with a disability, or maybe even a cousin that doesn't make up to a certain amount is able to qualify for head of household as long as they have a qualifying dependent. And then we have single. We like these numbers to increase because before your tax is calculated, these numbers are subtracted off of your income. And so this is ideal. And when you, we like this because for those that are like homeowners, they get a little bit more than someone who's not a homeowner. So as these numbers increase, they just help give a little bit more, I guess, benefit them a little bit more and make them feel, you know, like a homeowner and don't feel bad about it. So this is, I mean, they're not huge increases, but they all add up. And so it'd be good to know that if you're married filing joint, with your income, automatically the first 24,800 will not be taxable. So that's good to know. And then if you were single, you got the 12,400. Head of household, 18,650, and married filing separate is 12,400. I do want to mention for those that may be married and filing separately, for whatever reason it could be, I always recommend trying it both ways. For me, at the end of the day, unless again you absolutely have to do it, there are ways that if you're doing it because your spouse owes money that you really didn't sign up for and you want no part of, you could still file as like an injured spouse or an innocent spouse and still be able to benefit as married filing joint without the government or the state taking your portion of the refund to bring more money in the house. Because at the end of the day, we want to know what we can make and what we can keep and not give over to the government. Britt, can you go to the next? Britt, you there?
I'm here.
Can you move to the next slide, please?
Yes.
Thank you. A charitable deduction available to all. I do really like this. I hate that the limit is so low, and whereas they're only allowing you to deduct 300, but I do like this because I sit with a lot of clients that are renters. They're not homeowners, and they have all these receipts saying, I donated and they told me I can get a tax write-off, and I got to be the bearer of bad news to tell them that they can't. And so this year, because the government wanted to really give an incentive to everyone who was able contribute to charity, they are now going to allow, even if you're not a homeowner and you do not itemize your deductions, you will be able to take advantage of gifting to a charity, and that would be church, even if it was of goods like Salvation Army, Big Brother, Big Sister. And again, the income limit, the deduction is only $300, but again, it all adds up and it just shows a little bit that the government cares, and us helping each other. So I do like that they allowed this time, and hoping that it's something that they'll continue to do. Britt, can you move on to the
Yeah,
next?
it all great
Go
point.
ahead.
Great point, Liz, because it all adds up depending on how many other things you have. Great point.
Absolutely. Another good thing that's going to happen, and typically happens every year, is that there are higher income brackets. And why this is important is because it allows you to make more money and pay less in tax. I typically like to keep my clients at the 12% and pay no more than that, if we can legally. And but it's still, and you'll see as it gets higher and higher how the threshold, and that's one of the reasons, if you think about it, is to keep the rich rich and the poor poor. I believe in flat tax, and one of the things that they did, not flat tax, well, yeah, flat tax individually. What they decided to do was flat tax corporate. And so now that's helping all the larger companies. But what they did to offset that, they went ahead and adjusted what our income tax brackets were as an individual to make up for what the larger companies weren't paying. And so that's why it's even more imperative and important to know not only what you're making, what you're keeping, and if it's not enough and you're still paying too much, what to do to make those changes. Which brings me to the next slide. So higher contribution limits to some retirement accounts. Now, when I talk to a lot of people, the first question they ask me, well, how do I pay less in taxes? When you're working for someone, W-2, they tell you what they're going to pay you, how much you make, and they provide you with this W-2, your pay stubs and your W-2s. There's not much wiggle room you have. The only wiggle room you have are the benefits that they allow you to take through the company, and that's only the real way to lower your income. So one of those are contributing into retirement accounts, your 401ks, your 403bs, you have 457s. These are accounts that allow you to contribute, and they're pre-tax, meaning you make they take out your contribution and then they tax you. So I know that I sit down with a lot of individuals, and when I'm going over the return, I have to say to them clearly, taxable wages and not gross wages, because they'll look at that number and say, I made more than that. Why is that number so low? And I ask them, well, do you want to hire? That's the object. The object is to make the money, but then put it somewhere so that the government isn't getting it. So a lot of people's like, well, I can't contribute anymore, because they figure if I tell them to put at least 250 more away, whether that be weekly, bi-weekly, monthly, they're just like, that's too much. At the end of the day, it got to go somewhere. So whether you put it in your pocket, which is the right pocket, or the left pocket, which belongs to the government and state, is going somewhere. So it's better to just put it away for yourself, retirement, where you know you're going to need it, allow it to grow and work for you, opposed to just saying, no, I can't do it, I can't do it, and now complain once you have a higher tax bill or you feel like your refund's not high enough. You gotta pay yourself first. You get up every morning, you're the one who worked hard for your money. So it's only right that your money in turns, you're able to keep it, and then you're having it work for you. I learned that one from Michelle.
I appreciate that. Liz, I mean, you bring up a great point, is that either way you're going to pay, either you pay yourself or you pay the IRS, right? So you got to choose. So again, you guys, this is the gems that we drop here about you building wealth. You cannot build wealth if all your money's being gobbled up by taxes, because it's not again, how much you're making is it's what you're also keeping of what you're making and how you grow it. So excellent job, Liz.
Yeah.
Good.
And then just for some that may have it, you're able to put in as high as 19,500 if you're under 50, and then you can add an additional 6,500. That's a good amount of money that you're putting away for yourself. And again, it just helps you to be able to keep it and someday get it, opposed to the government using it and abusing it and just doing what they're very good at. Higher contribution limits for HSAs. This is important, and what I like for a lot of people to take a look at is because I too get a lot of questions regarding medical expenses and people keeping receipts and then bringing them in. Oh, I had this much in medical. Well, medical, for one, it has to pass 2 tests. The first test is it needs to be more than 10% of your income. Now, I don't know about you all, but for me, I don't want any type of medical expenses that's going to add up to 10% of my income. Why? For one, it's expensive. That's just telling me I paid a lot, but then it's probably telling me that I'm sick. But any event that we are and we do have, it'd be good to be able to take those deductions, right? One way you can is going to be through an HSA through your work. That allows you to put money away, again, pre-tax, so you're already getting the benefit, and that way you don't have to worry about keeping receipts and adding them up and seeing whether or not you're going to pass that test of the 10%. Actually, the other test too is you have to be able to itemize deductions. You heard me in the earlier slide where you have the standard deduction of the increase. Well, there's 2 deductions that the government allows you every year to deduct. It's either the standard, which is what we discussed in those earlier slides, and that's what the number that the government decides on. The other one is if you itemize. Most people who itemize are homeowners. On that schedule, you're able to deduct medical, charitable contributions. You have your private mortgage insurance, real estate tax, excise tax, mortgage interest, and a couple other things that go once they'll put it on and then they'll take it off. But those are the major ones. And so if your medical expenses they need to exceed more than 10%. So if you make $100,000 a year, in order for you to get anything, your medical expense needs to be more than 10,000, and you only get the difference. So let's say you had medical expenses of 10,000, you get nothing. If you have medical expenses of 10,100, you only get a deduction of 100. So this way, going through your company's plan and putting that money away and having it pre-tax, you get the benefit. You don't have to worry about saving receipts and about how much it is. You put, obviously you want to make sure that you're not over contributing to it to now stress yourself out and say that you need to spend all this money. But it allowed you to be able to lower your income, your taxable income, and pay for expenses that you're normally paying for after tax. So that's the idea, to get as much as income deductions you can for what you're paying for using after tax dollars. And that's one of the ways you keep a good amount of your money as well. You can go to the next slide. This one is, I don't know, a lot of people don't know about the Savers Credit, and that's because it was a credit that really only geared to low, maybe middle class families. And what it is, I like this credit because a lot of people says how shady the government is, and we learned this over COVID. We understand that the government is not here to take care of us or care about our needs. And we know that because we got issued, and not all of us, $1,200 plus $500 for a dependent, or $2,400 if you were married filing joint. I don't know about you all, but I have 4 children that are between 10 and 15, but they look like grown people. That just didn't do anything. It was like you just spat in my face. You're better off kept that, and so I like this credit. It just reminded me of how the government is not there for us and how they're not going to be there for us, and you're gonna have to do this yourself. The background to this credit is what they're saying is that if you're married filing joint and you made 65,000, and you put money away into a retirement account for work, and it's based on it's a ratio, so it's not like a fixed number, then you're eligible for the savers credit. What do you think they're telling you here? What they're telling you is do not rely on Social Security, and you better start putting money away for yourself. They're giving you a credit. A credit is better than a deduction. A deduction is deducted before your tax is calculated. A credit is used to net against your actual tax once your tax has been credited. So they took another step further to say, we really, really want you all to do this. And so I think it's very important that you all understand that you have to put money away. Now, you're not going to do it just for the savers credit. You may not qualify for the credit, but this is just confirmation that the government is not going to be here for you.
Right.
And once you hit retirement, what if you are eligible, if Social Security still exists, it's not going to be enough for you to live off of.
Correct. Very good.
Can you go to the next slide for me?
Yeah, just so you know, guys, Liz brought up a good point. Just again, we're going to hold the questions to the end. So put in your questions in the chat box. We saw some other individuals coming on. Please put your questions in the chat box. I just wanted to make a comment just based on what Liz is saying. Please take note that she's talking to you about all these other credits and deductions and what the differences in them are. These are all the loopholes that are out here. So any of you guys that are on there doing your TurboTax and stuff like that, there's a lot of things that you could be missing because it may not be your area of expertise. If some of this information is blowing you away, again, think about, again, if you are doing your own taxes, you could be missing all these goodies. These are legitimate goodies that she's giving you, that you'll be able, to be able to set aside. Okay, so just so you know, she at the end are going to cover a little bit more in detail. Liz, just before you move on to the next, can you just explain just really quickly again the difference between a credit and a deduction? And again, you guys, if you got questions, still pop them in the chat box, but I definitely wanted to ask that. If you just repeat that again, what the difference is between a credit and a deduction.
Yeah. So this is, I'm glad Michelle is saying that, because this is very, very important to know and to understand. If you don't know anything else about taxes, what you want to know is the difference between a credit and a deduction. So deductions are above the line items is what we call them. And those are the items that we deduct from your income, or your taxable income, rather. I got to be careful what I say. From your taxable income before they actually calculate the tax. And so wonderful. Let's say,
I said, which is wonderful.
Yes. So let's say you made $100,000. No, let's say, yeah, we'll keep it even numbers. $100,000. You paid student loan interest of $2,500. You get to deduct up to $2,500 in student loan interest, up to now, and it depends on your income and your filing status. But that is a deduction. So that $2,500 is going to be deducted off of that 100 before your tax is calculated. Opposed to a credit, you'll get that deduction of $2,500. And then now you have your wages or your income minus your deduction, your student loan interest, your standard deduction, or your standard HSA deduction, or your, oh my goodness, why am I Schedule A,
Don't worry,
Schedule
don't
A.
worry about it,
Itemized
Liz.
deductions, sorry. Your itemized deductions. And then you have taxable income. Now we're able to calculate how much tax you should have had withheld. And you come up with a number. Let's say that number is 6,000. Well, you have children. This year, it's 2,000 per child. And so let's say you have 3 children. That credit 2 times the 3 is gonna wipe out that 6,000 and it's 0. So the credit's a dollar for dollar against your tax. Whereas a deduction is deducted, it just lowers your income before the tax is calculated. So you ultimately want more credits than deductions. You obviously get what you can take, but the real effect and what will allow your refund to go up or your tax bill to go down are going to be those credits.
Right. And so you guys, again, just for easy math, Liz, I'm going to just drop it down, that number, John, just a little bit. So example, what she's saying, again, if you make 50,000 and you're able, let's say, to deduct 5,000, that what they're going to do, you make 50, they're going to minus out the 5 from your 50, and they're going to tax you on 45,000. Okay. Now, that's reducing. They're deducting it off of your adjusted gross income. Now, with a credit, like she said, if let's say you have 3 children and it's $2,000 per child. So again, we're already working with your income now being adjusted down to 45,000, right. But now you have a $6,000 credit. So Liz, now the person has a $6,000 credit. How is that beneficial with now that your income has been adjusted to 45,000?
So the income has been adjusted, which is good, which lowers your tax bracket. So let's say now you're in a 10% tax bracket, and now it's 4,500 is your total tax. This is what they're saying that you were supposed to have withheld during the course of the year, whether that was through your paycheck or through estimated tax payments. 4,500 is your bill. You have 3 children. That 6,000 is more than that 45. So that will lower, and it will zero out. It will zero out, and so now 45, it will just go up to the 4,500. So now your total tax is 0. So whatever you had withheld during the course of the year, let's say it was 5,000, that 5,000 is automatically your refund. But it just so happens that we're talking about the child tax credit because they have a refundable piece to the child tax credit, which even if your tax is 0, they will give you some towards the bottom. And so that's 6,000. You're like, hey, I only got 4,500. Was my other 15? We'll add the 15 down the bottom. And so now you'll have the 5,000 coming back to you that you had withheld, plus the additional 1,500 so that you get the full 6,000 for your children. And now your refund is 6,500.
Yeah.
Hopefully
awesome.
that someone got it.
Mm-hmm. Yep.
Definitely so easier to see on paper.
And again, guys, I'm gonna try to piggyback back and forth because I know sometimes even when Liz talks to me, I get glossed over because she's in her element. And so sometimes I have to kind of slow her down and we don't realize it. And she knows, no disrespect to her. When you're in our element and we're going, we think that everybody understands our language. So that's what I'm going to try to kind of mitigate that a little bit. Okay. But you're doing great, Liz. Go ahead.
Yep. Okay. And so now we have, and we're on credits, an earned income credit. So an earned income tax credit it's a credit that a lot of low to middle class families receive. Every year it goes up. It doesn't go up high enough, but it does. For 2020, you'll see that it is up to $56,844 from 2019, where it was $55,952. And all other tax filing statuses like single, head of household, that's up to $50,594. Now, if you're married filing separate, you do not qualify for this credit. only is married filing joint, married filing, not married filing joint, single, or head of household. So that's important to know too. And that's why for those that are married and they file separate, why I often say, hey, if there's a way that we can get around this and you can file joint just for, certain purposes, credits and deductions that are beneficial to the family, it's better that you all get it opposed to the government. Um, this earned income credit is, you'll see on the slide to the right that it's calculated after your, and it's in the under the payment column, because this is something that the government is giving you. It's based upon your income. It's based upon the number of children that you have, that you're able to claim on your tax return. And it's up to $6,660. And so that's a credit that, that it helps those that are unable to work full time but have children, because someone needs to be home when the children get out of school. It just helps for someone who can't get, a high paying job. It helps. It's just one way of the government saying, you know what, we understand it's hard, and this is what we'll do for you. The reason why I wish they would have increase these limits or did a little bit more this year is because there's going to be a lot of people that typically qualify for this credit and really count on this credit that aren't going to qualify because of the COVID unemployment. So if anyone was unemployed, and especially when you receive the extra $600 a week on top of whatever you had qualified for, that unemployment could potentially put you over the income limit, because unemployment is not considered earned income. In order for you to qualify for this credit, you have to have wages, either a W-2
Right.
working for someone or self-employment income. Now, the problem is, although those are the only incomes that qualify, when to see if you are eligible for the credit, all of your income is included. So you could have made 20,000 for the year, and that 20,000 could have been 10,000 on a W-2 and the other 10,000 from unemployment. Because that unemployment is so close to your regular wages opposed to the full 20 being on your wages, it will lower the potential credit that you can get for the earned income tax credit. So that's going to be one that I'm really looking out for, and probably will do a couple of plans just to see how that works for people, just to try to give them a heads up. Because again, those that qualify for that credit really look forward to having that credit. And I just feel like there's going to be so many people disappointed, although they were happy getting the extra from unemployment. They're not understanding or won't know or thought about how that's going to affect their tax return for 2020.
Yeah,
So if
excellent
you are
point, Liz.
someone that does qualify for earned income credit, I think it's a really good idea, if you have someone doing your taxes, to reach out to them and see if they could create a tax plan for you, just so that there's no surprises. And if you don't, I suggest you reach out to one, and we'll be happy to help you with coming up with a plan, just to see where you're at, to make sure that you're not hoping for money that's not going to come. While we're on unemployment, I do hope that those that were eligible for it and receiving it had taxes withheld. If they didn't, just understand that unemployment income is taxable income. And so if you didn't have withholdings out of it, they only do 10% max for the federal and 5% max for the state. That still may not be enough. So it's very good if you just be proactive. That's how we save things, and that's how you become that millionaire and build generational wealth. you prepare and you plan. So you are being proactive opposed to reactive. It costs more when you're reactive, and it's, you know, it could be
Right.
avoidable. It may be avoidable. So that's
Right.
something that I want you all to get from that unemployment. A lot of people are going to be really sad about it.
Right.
Michelle, you wanted to say
And again,
something?
I just want to again, I just want to, you know, drive that home. Unemployment, you again, that is not earned income. Okay, that is just a benefit that you received because you had worked before, but this is just a benefit. The interesting thing is, even though a lot of people have been getting a large amount of money in unemployment benefits, right, and it's not considered earned income, they can't give you an earned income tax credit, but you got to pay taxes on that unemployment income, right? You see how that works?
Yep.
Okay. So again, it's just unbelievable. That's why it's so important for you to be working with a tax professional, whether you have decided to have Liz do it or whether you're working with somebody. That's why we like to have taxation strategists, so you can have these conversations throughout the year, right? Not waiting until April of next year, and
That's
now
right.
you're holding a ten or $15,000 tax bill because you didn't have your withholdings, you know, being deducted out of that unemployment income. It's all fine and dandy when we get it, but then we realize it's too late, that we gotta, you know, cut a check to the IRS, and we could have avoided that. Okay, so please
Absolutely.
take heed of that.
Britt, you can move forward. And the last one I'm gonna go over before we get into the goodies, and I'll show you how we can do some things as far as starting a business. And I know I seen one question in the chat earlier. Um, can I hire my child? And all four of my children are hired, so yes, you can. But I should have actually put this one higher up on, but a higher cap on Social Security payroll tax. We know that the highest tax that you actually pay that is non-negotiable and there's no adjustments to be made are your Social Security. It accounts for 6.2% of your income that you make is taxable. It's a Social Security, and so they raised the limits, which I think are stinky, because when you look at what they've done for the deductions and how they only raised them 200, only raised them 400 for the Social Security, they actually raised it up to up $4,800. So last year in 2019, you were taxed on up to 132,900, and this year now it's 137,700. So any of you that are over the 100,000, 132,900, now you're going to be taxed on 137,700 before you've maxed out on Social Security. The part that really messes with me is what I mentioned earlier. We're not even sure we're going to get Social Security. You see what one, I don't think it's going to pass, but one of the things that Trump is trying to push through right now is give people the option of delaying and not withholding their Social Security taxes right now. And it's just the worst idea that anyone could think of, but it's just going to show that Social Security, we just don't know how long it's going to be around, and that's because they misuse the money. It's not being used the way that it's supposed to be used. That being said,
Right.
although we're paying all this money and they're taking us, no matter
Right.
what, you make a dollar, they're taking they're taking their 62 cents. What, not 62 cents point, well, it's going to be 0.0, but they're taking it no matter what. So that being said, you want to figure out ways, and you want to now try to earn income, or not really earn, but have income that may be taxable but not taxable for Social Security. And so that's
Yes.
another way that you win. Not all your income got to be income that you got to pay Social Security taxes on. And that's another way to win. Rental income, if you have a business, not self-employment, but another type of separate entity, you have your investment income. So that's another way to build generational wealth and to pass the torch, is to just making sure that all of your income is not being taxed. That's the only way to get ahead. The
Right.
only way to get ahead.
Right. And I'm going to, again, I'm going to repeat what Elizabeth said. Okay. Because first of all, we know that there are some professions that don't pay into Social Security. Okay. I understand that, because I think police officers, maybe one of them, again, they don't pay and they
Yeah,
can't collect.
they can't
They
collect.
don't
Yep.
pay and they can't collect. But you guys just understand, Social Security was designed to be supplemental. It was not,
That's right.
okay? It is not designed to be your only form of retirement income. It's supplemental. In a nutshell, in addition to, okay? In addition to what you have in your IRA. It's supposed to be extra in addition to whatever you're going to collect from your pension or your 401k and your 403b. It is not. It is not part, for you to be your only source. It's supplemental. It becomes your only source when you have not done what we talk here at the Building Black Wealth series. If you've not started putting away money at age 25 and 30, if you haven't started putting away at 35 and 40, okay? That's what we encourage individuals to start investing your money sooner rather than later. But what she did say, that you can avoid, legally, by paying that Social Security payroll tax. Once again, wealth building strategy. If you own investment property and you're collecting rental income, again, we talked the two biggest ways to create wealth is investing in property and investing in, whether it be mutual funds or stocks. Okay, and then the other other way to avoid that, which I don't know if you caught that. She didn't say being self-employed, she said being a business owner. Okay, a business owner. That means whether you get out of bed or not, that business still keeps functioning with or without you. That's having an S corp or a C corporation. Okay, way different than you just having being like an Uber driver. Okay. All right, go
Absolutely.
ahead. Go ahead, Liz.
Yeah, absolutely. Very, very good points. Do you want to do questions here, or do you want, the business is going to be a free for all. People are just going to ask again. It's just what I have it as is.
I think Liz, just go through the content,
Okay.
because Denisha's on the side, because again, you'd be able to get through the content, because right
Okay.
now all the questions that are coming in are probably a blend of each. And so that way, if you get through as
Okay.
you're talking, we know that people are going to be coming up with more questions, and you guys are doing awesome. Definitely just pop in your questions in the chat box. We are monitoring that. We're keeping a list of it on the side. So again, just make sure you pop in your questions, but go right ahead, Liz. Thank you.
Okay. Thanks, Brett. You can move on. So the last thing I want to go over with you all, just because this is about building wealth and making our money for us, is whether or not you should start a business.
Yes.
And I am going to say this year, is, if it hasn't smacked you in the face as of yet, if you look at the money that has been discussed back and forth, a lot of the potential were made for the business owners. And so, though, whether you were self-employed or you had an actual, a C corp or S corp, a separate entity business, those businesses were eligible for funding that would just allow them to do many, many different things. And I will tell you, from my business, none of my clients are suffering. I've seen so many people that COVID actually helped them. meaning the government, this forced the government to put things in place that for some companies they're doing better than they were before COVID.
Yeah, yeah.
And even people, and that's just if you do the right thing with it, because you could get something, be blessed with it. I'm a very spiritual person, but you can do the wrong thing with it and find yourself in, worse shape. But starting a business, I think right now is just like the best time, because it allows you to make your decision on who you're going to work with, how much money you're going to make, when you're going to work, but most importantly, how you're going to structure yourself to say, hey, government, this is what I'm going to pay you for taxes, because this is all I
Yes,
want to pay you. And
exactly. There
yeah,
it is.
that's what's most important.
Yes.
So I create plans for myself to say, hey, this is what I want to pay this year. And I create a plan to put that in place. I'm not trying to be greedy. I understand we got to pay taxes. I just don't want to be paying taxes for someone like Trump who ain't paying taxes. So starting a business is definitely key. So if there's any hobbies that you have, things that you like to do, things that you do for people that that you're not monetizing on. I mean, and I've seen, I wasn't on Facebook a lot, but every time I got on Facebook, people were starting businesses, whether they knew it or not. They went into survival mode, whether it was mask, it was smoothies, because everybody was on their health thing now. There was so much, and I loved every bit of it. I loved it because it put a sense of urgency to say, hey, I can't work, I can't go out, but guess what? Your expenses still exist. That mortgage still needs to be paid. That rent needs to be paid. It doesn't matter that the government or the president say you don't have to pay it. Just by having love and respect for people, knowing that if you're a renter and you know that your landlord got to pay a mortgage, you don't want to put them in a bind to be losing what they have. So you want to be able to help. That's how we get ahead, by helping each other. And so you want to start a business if it's something that you feel that you can monetize on. Now, I do know a lot of people who start businesses and tell people to start businesses, so all they can do is write off expenses. That's only good for 3 years. Not only that, what happens and what I see come across is when you want a house, when you want some type of funding, and what I've seen a lot this year when COVID happened and they were able to get funding. If you didn't have net income and you had a ton of losses, you weren't eligible for any type of funding. You start business to make money. And that doesn't necessarily mean you have to pay a ton in taxes. It's just, how do you do it? You structure it correctly. Do I incorporate? Don't I incorporate? That's going to depend. It depends on the type of business you have. It depends on what you want to do for the business. It depends on how much money you can potentially make in that business. It depends on whether or not you have children, how old those children are. It depends on the structure of the business. So I know that I always, when someone tells me they want to start their business and what entity, I do have a template that I can forward to Michelle and Denisha if you all want, and that just gives an outline and a breakdown of the different type of entities, what they are, what does it mean, and how are you taxed on it, to help people get a better understanding of the differences between the different type of entities, between being self-employed, just a regular Schedule C, filing that on with your personal tax return, or an S Corp, which is a small business corporation, where it'll file a tax return for informational purposes, but the net income is passed through to you as the business, the shareholder, rather. The only thing, the biggest and hugest difference is that you're not subjected to self-employment tax on that net income. Then you have your C Corp, where it's a completely separate entity from you, and it has nothing to do with your personal affairs whatsoever. And then you have your LLCs and your partnerships, that I like and don't like, that I won't get into now, but there are different type of entities. So I do have a spreadsheet that outlines the different types and what they mean, and just gives you a description on how many owners of people who can be involved, and how they're treated tax-wise, to help you come up with questions to see what's best for you. Um, Also, when you start a business, you know how we drive around and we're going to stores and we're picking up supplies, or we're networking, we're meeting with people to talk about our business. Well, if you're a business owner, you're able to now take some of that mileage, and auto expenses that you have that are just normal, you're using after tax dollars, and make them business expenses, which will lower your income. It allows you to make money, and now you have those expenses to offset something that you weren't normally able to deduct. You can't deduct your gas anywhere, or you can't get any type of deduction for your mileage anywhere unless you own a business. So that's another reason
Right.
why owning a business would be good. How about having a room or an area in your home that you work out of? I'm hoping where a lot of people had to work from home, that they're going to incorporate some type of a deduction for those that work from home, because I know clients that were buying desks, they were buying chairs, they were buying computers, they were doing all this stuff because they had to work at home and they needed to be comfortable. And we don't know if the government is going to put something in place for them to be able to deduct. They use their energy, their electric, their gas, um, their insurance, that you have all that, your utilities automatically increased. Your internet you're now using, but if you were a business owner, you wouldn't have to think about that. You would know for a fact
Right.
that that's going to be a deduction that you're going to be able to use and benefit from. And so that's another reason
Right.
why owning a business is, again, you have um, these expenses that you're paying for personally, but could be an actual business expense, and say, hey, I don't want to pay taxes on this. And that's what it is. It's getting the mindset to say, what am I doing personally that I can make a legitimate business expense, so that I don't have to pay taxes on that. And
Right.
that's
And
how
Liz
we
and Liz
save our
brings up
money.
Liz brings up a good point, you guys. Again, so just kind of just to back up, because I know that was a lot. So Liz, I'm gonna just break that down a little bit,
Yeah.
okay? So again, a lot of people who were W-2 employees, when you were, on your job, had you, again, if you were fortunate enough to work from home, and again, everybody was at home, whether they liked it or not. But then when they started kind of getting back into the swing of things, some people had to go and some people were allowed to stay home. So like Liz said, to make themselves more comfortable, again, you as a W-2 employee, your company didn't give you an expense stipend to make your chair more comfortable for you to work there. They didn't give you an ergonomically correct desk. Or maybe a proper laptop or computer, all the things that you may had to have come out of pocket on your own. Again, when you're at home, now you're using your internet more. That's why the service kept getting shut down. So a lot of times, as you saw earlier today, right, there's always these computer glitches because if their network is overloaded. No wonder why they're trying to put 5G in, whether we get cancer or not, right? They're still looking to put that in. Okay.
It's
Okay.
true.
So, right. So all your utility usages are up. Right now, where it's hot outside, maybe your air conditioning bill is up much more. Food, because maybe you got a little bit extra snacks and things like that. People have been packing on the pounds, too, from snacking. I know I have, right? So all these things, there are a lot of things that have gone up. Interesting thing, your pay may have stayed the same, but your expenses maybe on another
Increase.
side have gone up. You didn't go to Dunkin' Donuts and Starbucks and buy your lunch and whatever, but you purchased all these things to be able to work from home, but you guys, your W-2, you weren't able to write that off. So when you're Zooming all day using your internet, you can't deduct that. When you're using your cell phone calling all these clients back, whatever, for your job, you weren't able to deduct that. But if you were an entrepreneur, if you're a business person, you're able to deduct that. Like Liz was saying, again, if you picked a little corner in a room or an actual room, again, you can't have a baby rattle in there. That's not a true deduction. It has to be strictly business, okay? Again, we're not going to really deep dive into that, but the bottom line is that if you're an entrepreneur or self-employed individual, you can write off that square footage of that one room. You can write off your cell phone, your utilities, your expense, your cable bill, your cell phone bill, all those type of things. If you decide to get a company shirt with your logo on, now you can write off a uniform, right? You can write off a uniform.
Right.
You have to worry about doing laundry. You can do that. These, I learned, Liz, I know the loopholes, right? Again, it's all about, these are all legitimate loopholes. She's been teaching me.
That's right.
And this still, listen, you guys, and it's still not enough that we can't cover it all tonight.
Absolutely
okay?
not.
There's just
Absolutely
way too much.
not.
It's just like with even us doing this series. That's why we keep breaking it up in bite-sized bits. There's still so much. But again, she's saying that if you were self-employed or you were a business owner, you could have deducted all that. But by you being a W-2 in person, not unless your company's going to, you can expense it back to your company. Good luck though. Okay, good luck. But those are the benefits you have. That's what the true, again, just like she said earlier, and like we always say at our seminar series, the rules to wealth creation are for business owners and entrepreneurs. That's it. However, if that's not for you and you are an employee, there are deductions that you can get to help lower your tax bracket, and then there are credits. Okay, and there are credits. All right, let's continue.
Absolutely. Other things that you can, like Michelle said, we could be here day, night for about 5, 6, 7 years. And again, when you're talking about taxes, tax planning, they're so customized that we cannot go over it. So it's just to give you a general idea of what people typically have, that we all have, that we can say, okay, maybe this can work for us. You could, when you have a business, depreciate your vehicle. Now we know as soon as we drive off the lot and we have purchased a vehicle, that vehicle depreciates in value. So knowing that, wouldn't we like to have some type of deduction or something to benefit us on our taxes for that? Well, you're able to do so if you own a business. What depreciation is pretty much taking that value and being able to deduct a portion over it over a certain amount of years, so that it gives you, so like with a car right now, get this, when you own a business, you are able to expense $1 million, up to $1 million in depreciable assets, computers, cars, desk. So that means if a business started, they make $2 million and they purchase furniture, equipment, vehicles, 500,000 right off. If they choose to, they can take that 500,000 all in 1 year, which automatically lowers their income to $500,000. That's crazy. Or
Liz, just to prove your point, I know a gentleman that has a business that they think they did about $2 million in sales. This so far, and he has a seasonal business, a pool business, right? You guys, she's telling you the exact truth. He's now buying a house on the Cape for $1.5 million and just bought a boat a couple of months ago before to reduce his tax bracket. That's what wealthy people do.
Absolutely.
So we can't hate. We have to learn how to use those loopholes. Okay. So when you think that they're making all these big payments on the big house like that, no, that's deducted off of either their estate or somewhere part of their business. Okay.
Absolutely.
So you gotta be very mindful of that.
Very mindful, and I do it for clients all the time. Tax planning. I'm not sure if anyone read my my bio, but more than half of my clientele are self-made millionaires. That has nothing to do with me, and it's just providing the guidance explaining things to them, and them following. It's their money. They worked hard for it. And because they've listened, like Michelle said, what usually happens is now your income is high, and now you're going around trying to figure out what can you spend on. So because again, at the end of the day, you either buy that boat or you give it to the government. Well, I'm gonna get the boat and maybe just sell it. If I don't need the
or
boat.
charter it, or I'm going to charter it, right?
Or charter. I have one client who bought the boat and now he rents the boat.
Yep, you can charter it. I see all the time when I go back home to the Caribbean. All those boats that I see in Boston, I see them down there in the Caribbean. You guys, these are all loopholes. Again, contact your tax professional. Okay, if you don't have a proper tax professional and you want to take on Liz's services, definitely, again, we'll give you her contact information. You can reach out to her. She is a bona fide taxation strategist, not just a tax preparer, a taxation strategist. Her job legally is to find all the loopholes that you may not
legally
be aware of. And and there are some things that you may be blind to, she's going to suggest you to do certain things. Just like she said earlier, sometimes she suggests people to start a business, okay? Even if you just hobbied it out for 5 years, you can at least maximize it for that 5 years. But I'm staying in my lane. I'll let her, I'll talk about that.
3 years. It's 3 years
now? Yeah.
It's 3 years. Yeah, because a lot of people are doing it. So it's 3 years. So even if it's something that you're looking to buy down deductions for a little bit, you have that 3 years. But after that 3 years, you need a new game plan. And the last thing that I'm going to talk about, because I see it a lot, but only because I'm a mom. I'm a mom of 4, and like I explained to you, my children are expensive. I have 2 boys and 2 girls. Between football, basketball, you have gymnastics, you have the clothing, you have a food bill. It's just, they're expensive today. And so when you're self-employed, you have the option to hire your children. And our children are very smart today, a lot smarter than we were, especially with the electronics at a younger age than we were. And it's our job to teach them. Charity begins at home and spreads abroad. And so, they can go to school. You can put them in this program or that program. But if you're a business owner or you start anything, I know, like with me, how I started to be an accountant and knew what I wanted is because my mom worked 2 jobs for as long as I could remember, and even went to school, and she was persistent. My mom graduated and got her bachelor's at 50, and I cried like a baby because of her persistence. But while I was growing up, to help her maintain things, she had me do a lot. And one of the things that I had loved doing was going through the bills and writing out the checks and being able to budget. And I mean, till this day, I just, like, I can't figure out from what she was making, how she was able to do the amount of things and provide from what she was making. She used to bring us to her work. And she would pay us a little stipend for doing her work. So although she didn't have her business, she included us so that we would have work ethics. The minute I was able to get a job, I was working. I was doing people's tax returns when I was about 15 years old, when it was telephone. You did it by telephone. Like, it was just instilled. So one of the ways is, even though you may not have that business mind, the millennials now, half of them ain't gonna be able to work. They're, what do you call them? They're Michelle, you know the word? They're not gonna be able to work for someone, and they're gonna have to own their business because they're not gonna be able to listen to no one.
No, a lot of them are they're non-employable. They
non-employable. It's just
non-employable.
that it's not going to happen. So that being said, you might as well teach them now. What do you like to do?
Exactly.
And
Yeah.
get them to making their money now. And so, yes, my children are on my payroll. Why? Because I want my business to pay for football. I want my business to pay for basketball. I want my
Yep.
business to pay for food. And so when you start your own business, and obviously it depends on, again, the entity status, whether you're self-employed or a business owner. Either way, you still can hire your child, but there's different ways of doing it. And the way you hire your child, it'd be like you're hiring anybody else. And then that you get a lot of things out of that. But the most important is, if you're instilling good habits and work ethics for your children and teaching them, and you're found a deduction to lower your income by way of expenses that you never would ever be able to deduct. You can't deduct food anywhere. There's no way on a tax return. It doesn't matter who, there's no way you can do that. But one way you can is by providing a paycheck to your child. And you take that money,
Yep.
you put some away into, whether it's a Roth, it's some type of savings vehicle for education, or again, you use it for regular normal expenses that you were paying anyways, but you now made them into a legitimate business expense.
Absolutely.
So I could go all day again and all night with this. Like Michelle said, I go fast. I get very, very, not antsy, but I can just do this all day and all night. I feel that we are very uneducated. I feel that there are a lot of things out there that we need to know about, that we need to share, we need to spread, because a lot of times it's not what you make, it's what you do with what you make. To making sure that, again, you're only one person, so you can only make so much. What are you doing with what you make, and how is that working for you?
Exactly.
Is how you're going to get
Exactly.
ahead. That's how you're
Yep.
going to get ahead. So I do thank you all so much for attending. Again, if you just got one thing out of this, I'm elated. Hopefully you got something that you can share with someone else, because we're going to need to spread. We need to educate ourselves, but to spread it. We need to actually, so that's what it is. Developing a tax savings mindset. Thinking about what can we do to turn this taxable income to make it now tax free or tax deductible. We have to change our
Right.
mindset. And we're going to change
Yep.
that mindset by planning. You have to plan. You cannot just wing it. You can only wing it for so long. But when you plan and you make it, I mean, there's some things, it's not perfect, but you can come pretty close about 80% of the time.
Right. Right. Absolutely. And Liz, and we thank you for being here. Listen, I know that some of you guys that have been part of our Building Black Wealth seminar series since last year and the year before. Again, when we had Elizabeth here, I mean, we knew we had to have her back. I mean, again, like I said, I've been very fortunate to have known Elizabeth for a very long time. When her firstborn was in utero, okay, for a very long time, and so we've become great friends. Like Liz said, I met her through her mother. Her mother was a great client of mine, became a great friend, and they become like they're like family to me. And I watched Elizabeth just grow up. Into her business, because her mom was no joke too. Okay, her mom was no joke, right? So I know where she got that from. Her, apple doesn't fall too far from the tree. I'm telling you. So, but her mom is very proud. Just like she was proud of her mother. Her mother's extremely proud of her. Was it easy for Liz, like she said, growing up? No. She had also be like the mama bear to her brothers, who, pretty sure at times are very annoying, but she put them all in place. Little did she know that was preparing her for her to be a
That's
mom
right.
of four, right? Using all of that, but all the discipline that she went through. I mean, she used to work Liz was a corporate tax accountant for, I believe, two of the largest residential development companies in Massachusetts. They used to put her in a room and tell her, make it happen. She had to find all the legal loopholes. You guys, that's what she cut her teeth. Then she decided, to go with a smaller firm, and then left that, like the H&R Blocks of the world, because she found they're ripping off people in terms of just overcharging for simple tax returns. And then that's when she decided to kind of, to open up her own practice, and then focus on individual families, then the entrepreneurs, the small business individuals that were very underserved, and to bring that corporate tax knowledge to the little guy and help the little guy become a large conglomerate. That's what she's done. Again, the same principles that she used to help the non-melanated people, she's bringing that to the community. Believe me, she has an extensive client list. Like I said, her clients are range from the single mom up to the person that owns large multi-million-dollar companies. Don't get it twisted with that face. She is a wealth of knowledge. She's a wealth of knowledge. So what we want to do is to kind of peel back her brain a little bit more. We're going to have Denisha kind of go through the questions. We know that you guys, thanks for hanging in there. Thank you so much for the compliments. This is why we do what we do. Again, every second Wednesday of every month, we treat, Denisha, myself, and Britt, our job is to try to always bring quality content that if you're going to invest your time here, you're going to get something in return. That's why we want to have to make sure that even just myself, Britt, and Denisha, we level it up, but we also bring individuals here that help all of us level up. Because at the end of the day, we want to talk about that wealth building, wealth preservation, and then being able to have that wealth generation. Okay. So that being said, Denisha is going to get right into some of the questions that Elizabeth can answer for us.
Yes, ma'am. Hi, everyone. So we have I've just been cutting and pasting. We have about 30 questions.
Okay.
So I'm just going to go through them. The first one, you actually ended talking about it. My child will be 13 years old. My understanding is that childcare is deductible. Can you explain a little bit more of how you can utilize the employing your child, one, and two, the child care deduction? And there are a few other questions related to that I'll go into as well.
Okay. So, you're absolutely right. When your child is over age 12, the government's pretty much telling you that they could stay at home because they no longer allow you to take the deduction, not the deduction, it's actually a credit, the child dependent credit that is up to $600 that you're able to get as a credit. You'll no longer qualify for. And one of the best things that there's not too much you can do. Again, you could use that as if your child you had a business and you were able to put that child on payroll and deduct that expense. But other than that, the only other offsets would unfortunately be through any type of benefits that your employer may be able to offer you, to where you're able to take a deduction before tax is calculated. That'll be able to offset that credit for you.
Okay. And then you discuss being able, if you are an entrepreneur, if you can hire your children. So what does that look like, and what are the actual financial benefits?
Okay, so with your child, again, as long as you followed the procedures to, just like if you were hired anyone else, you have your children fill out a W-9, a W-4, an application, and set up to what that job is going to entail that they're doing. Because if you are ever questioned, you want to have some type of backup to support that it's all legitimate. And as long as you do that, because when you're self-employed, for example, technically a DBA is still you personally. So if you hire your child, that just means that child works for mom or dad. And so because of that, they're exempt from Social Security, and they're exempt from Medicare, which is huge. So that's 7.65% that everyone else needs to pay because that child works for their parent. They won't have to pay that or be subjected to that. So that piece is huge. But then whatever you pay them is 100% deductible to the business. And they only have to be 7 years old. So, I mean, 7 years old is a decent age to where you can learn, even if it's to shred, it's to scan, it's to answer phones. You can teach a 7-year-old a lot of things today.
Awesome.
And you could pay them up to $12,000 without them having to actually file a tax return or being subjected to any tax. So that's a good amount of money.
So wait, that's 12,000 each child. So if you had two, okay. I'm making sure people understand it's each child is $12,000.
It's each child, absolutely.
So this might be a great year to get your business launched if you have children to start writing.
Or have more children and start a business. Just saying.
And Liz, you said if it was a DBA, so is there a difference if you have children and now you have an LLC versus an S Corp versus a DBA? Does that matter?
It does. So again, it's still, you'll follow the same procedures, make them fill out. The differences, and the biggest difference is that they're not going to be exempt from Social Security or Medicare. So you'll still have to pay the Social Security and Medicare on them, but the benefits that you're going to get from being able to still deduct that expense that you're paying them is going to far outweigh what you pay into the state and the government for that.
Okay, perfect. Some related to children again. Let me see here. Are there deductions for homeschooling your children? So now that a lot of people, their kids are home and the parents kind of have to decide, if they're homeschooling, virtual schooling, are there any deductions, W-2 versus self-employed or an entrepreneur?
So with self-employed, obviously, you could take those expenses again and those pay them through the wages that you would pay your child. Right now, I know that is a hot topic within the IRS on whether or not or what they're actually going to provide as extra deductions, since so many people are home and haven't had to hire tutors or homeschool and had these extra expenses. But as of now, they haven't really said as to what they're going to do if they are going to do something.
Okay. Is it too late to benefit from any of the business tax breaks as a result of COVID-19? Because all of those have already passed, like the PPP funds. Is it too late for someone to start an LLC now or a business now and still benefit from any of that, or?
For the PPP, obviously, where that's not no longer on the table, no one else can apply for that as of Friday. Friday, I think it was last Friday, or they had a Saturday date. But for the EIDL, which was the Economic Industry Disaster Loan, that right now is still going on. And that's a loan, I think the max that I've seen was about $150,000. The lowest I've seen, or someone, maybe about $10,000, where it's a 30-year loan. It's based upon your income though. So someone who's starting would probably have to put projected income. Actually, no, that it is going to be, because they're basing it off of 2019 info for that. So yeah, for those newer companies right now, there's no funding availability. But as far as starting it and being able to take deductions, and even if they're not able, you haven't earned a lot of money, usually the first 3 years, your expenses, depending on the type of business that you have, your expenses exceed your income. So at least it will be a good deduction for you. And depending on what type of business you are, if you have other income, that net loss could offset that other income, which brings down your income. If it's like a C corp, a separate entity, then you could carry that loss over until you have a profitable year and use it then.
Okay, perfect. I think you answered this, but I want to just make sure we answer everyone's question. All of the money people have received from the government, stimulus checks, business allowance, everything, will you have to repay any of that back? Or is that in the form of taxes, or you have to actually give all of it back at some point?
The stimulus was 100% free. So no one's going to have to repay that. For the PPP, that is determined upon how that money was used. And if it was used towards payroll, because it's called the Payroll Protection Plan. So if they did not use 60% of that on their payroll, then some of it may be a loan and they have to pay it back at 1%. That right now is still with Congress and they're still going back and forth. Their goal is to try to make all of it, no matter how it was used, tax-free, but it's still right now, it's just a 60-40. You had to have used 60% on actual payroll. If you were self-employed and you got it, you would just had to have the rate. For the self-employment, that calculation is really a tough one. It's not as straightforward as the other one. So that one, I would need to speak to the person to see exactly the type of business, what they made and what they qualify for, to tell them if any of that would be taxable. And it's not taxable. I'm sorry. So your question was, is it taxable? It's not taxable even if it was considered a loan, because you have to repay it.
Okay.
So if you receive funding in loans, that's not taxable. So no, to answer your question, none of it's going to be taxable, but there could be a point where you have to pay it back because it was treated as a loan.
Okay. Thank you. Let's see here. If I started a side hustle received unemployment and stimulus, is there a threshold I shouldn't go over in what I'm making? So I guess they're planning for when they have to file in 2021.
It depends on the income, depends on how many children you have. It depends on the filing status. So it's yeah, those are, like, if you ever looked at the tax rates and schedules, it's not a straight line. It honestly depends on how much you made and the breakdown of what you made, or how much income your total, and how that income, whether it was income earned from capital gains, unemployment, W-2, self-employment. It depends on your filing status, whether you were single, married, filing separate. So that's definitely individual as far as trying to pinpoint a threshold.
So for the more complex questions, guys, I will definitely defer that you contact Liz. We'll share her contact information with everyone. We will share a copy of the presentation as well, so you'll have it, so you can refer to it. Let's see here. To claim a business, do you have to have a business tax ID?
Not necessarily. I recommend getting a tax ID number, but that is not true. You could operate under your social.
Okay. I am a new homeowner and would like to know if I can claim home repairs on my taxes. If so, is there a maximum or minimum amount?
If it is your personal residence, no. You would want to keep track of those, because if you ever sold the residence, your whatever repairs and money that you put into is with improvements would get added to the cost, which would be your cost basis. That will help decrease a gain if there was any. But for personal residences, the only thing that you're going to be able to deduct is your mortgage interest, real estate tax, and they may or may not get rid of mortgage interest, mortgage insurance premiums. Every year it's on the ballot to get rid of. They take it off, and then halfway through the year they put it back on.
Yeah.
So because people are upset about it. So those would be the only things if you are using a residence as personal. If it's investment income, then it's whatever you put into it, you're able to deduct. Dollar for dollar, baby.
Yep.
So
And also that means you guys too, that even if, let's say in your primary, I mean, it could be a single family home if you live there. If you move out of that single family home and you keep it and rent it, now it now becomes investment. Okay,
Absolutely.
I just wanted to clarify that.
okay, thank you. And then, would you be able to do another savers credit around tax season? I'm going to say a general because there are a few questions on the savers credit and circuit
Okay.
breaker credit, and I don't even know what those are. I learned about those tonight.
Ooh, the circuit breaker is a good one. That's a really good
That
one.
is a good one. The savers credit is a credit. So you just get this and it's based upon information that's reported on your W-2 that your employer reported. So based upon your income, or if you're self-employed too, based upon your income, and again, your filing status and how many dependents you have, there's a schedule of income that if you put a certain way of money away towards a retirement account, that the government would give you a credit for that. So you're able to do that at any time. It's just by the end of the year, how much have you actually saved versus how much you made.
Got it.
If that makes sense. For the what was the other credit?
Circuit breaker.
The circuit breaker qualifies for if you're over 65 and a half. It is a really, really good credit for the elderly, because if you're half of your water and sewer and your real estate tax exceeds more than 10% of your income, this is a state credit, not a government, not IRS, it's state, Massachusetts. I do all states, and I will say a lot of people talk about Massachusetts, Taxachusetts, but they're really good comparable to other states with having a lower tax rate. But then to like the circuit breaker credit, giving a credit to low income seniors, which is, really important. And that could be anywhere between, I think they increased it to close to $1,300. So you can get a max, but they will prorate it. So it's not an all for nothing, which is really good to know, that if your income did go over a little bit, you still would be eligible for a little bit until it got to just being way over.
Okay.
And before you jump on to the next question, Denisha, you guys. So again, I don't know if Jay Lewis is out here, right? But I remember hearing this: each one teach one. Okay. When I heard that, I never forgot it. Okay. So I think I saw your name pop up, but I'm not sure if you're still out here. But he's dead on correct with that. This information is about also you paying it forward. So if you have an aunt or an uncle that's over 65, a grandparent, your parents, and there's some accountants that I'm telling you, for whatever reason, that not all of them know about the circuit breaker, right? I mean, I've seen it happen when we ran into some people, and Liz is the one that had taught me about that, and I had to go back to some of my clients and have them send them either to her or have them go back to their accountant and go fix it. The great thing about that too is, like with all taxes, and Liz, you can correct me if I'm wrong, you can go back 3 years and make an amendment. So if that person happened to qualify, and if it's $1,300, they can, Liz, you can correct me if I'm wrong, if they go back 3 years and they didn't get it and they qualified for it, they can get 3 times $1,300. Okay?
$3,900.
That's a big deal, you guys. So again, forget about you not being 65. This information here is about us, each one of us, each one teach one, right? So definitely, maybe again, look out for the seniors that are out there. There's a lot of times that they don't have anybody in their corner, but just ask them if they ever heard of it, did they get it? And if not, again, call Liz and make sure they contact whoever is handling their taxes. All right, go ahead, Denisha. Thank you.
No, thank you. Do you get a credit for childcare, after school, or private school tuition, or is there a way to?
For private school, no. Only if, again, you have your own business and you choose to pay your child. Private school is something that the government just says if you choose to send your child to a private school, they won't give you a credit for that. But for the child tax credit, that is worth $2,000 up to $2,000, and that's for a child up to age 16. If you have children older, it's knocked down and it becomes a dependent credit, and that's 500, including like if you had your parent, your parent lives with you, and so they're your dependent, you can get 500 for that. I mean, before it was 1,000 up to $1,000, and it was just a child tax credit. So it's kind of good that now they doubled it. But then if you have other dependents, made you eligible to get an extra $500. And again, that's a credit and not a deduction.
Okay. Thank you. Can selling an asset too close to your retirement affect what you will collect in retirement?
It's very possible. Absolutely. So before doing that, I highly, highly suggest contacting and doing some tax planning. I had someone who called me that was their client, and they needed some assistance, and told them to call me, set up to do the plan before selling, and they went and did it on their own. No good. Because what will happen too, especially where you've already started creating Social Security says, hold up, you ain't say you
Right.
was going to be making that much. So
Mhm.
what Social Security would do is they're pretty much are going to bill you. And so instead of you getting your monthly check, it's going to go towards what you owe up until the time that is paid in full. Social Security don't play. They do not play. So it's very important that if you're close to retirement and you know that you're going to be collecting Social Security, or you already are, do not play with them. Just have a tax plan so you know what you're getting yourself into. Because remember, with Social Security, you're paying tax on this. You've already paid tax on this money when you were working, and now that you're collecting it, you're paying tax on it again. Do you want to go ahead and add more because you sold a property and put yourself in that situation? It's not worth it. It's not where you're already double paying for it. Why give them more?
Right.
Thank you. And a question tied into that: can you? I think you answered it, but I want to confirm. Can you pull from Social Security before retirement, especially if you're self-employed?
It depends. It depends on your age. It depends on your work credits. Every year you should be getting a statement from Social Security. And if you're not, they have an awesome online website. It's very
Yes.
user friendly. And I recommend, if you're not getting your statements, this is something that you don't want to wait until you get close to retirement and now you're checking it and they don't have all your work history or whatever it is. This is something that you want to actually get in at least every year to be checking on. And again, they have an online website. You can calculate if you wanted to retire early. It'll tell you when you can retire, what you'll be receiving. If you wanted to wait 3 years after your eligible date, what's the difference that you would receive? So I recommend definitely registering on the Social Security website. And Michelle or someone posted it. Get friendly with that. You want to know, if you want to know what you're, and then that's good for planning too, because if you have other retirement accounts, you're going to want to make sure that you're not, because you could actually, based upon your income and when you take your Social Security, they can tax you up to 75% on your Social Security. So it'd be really good to plan and know this. And again, if this is all you have and you have, plan for it and know what it is, or have someone else look at it and provide options, and maybe you can slow it down a little bit, so that, or not take as much income somewhere else,
Right.
so that you're not paying taxes on all of this money like this. If you do it right and you listen, what you'll find oftentimes is that you can find yourself in a higher tax bracket when you're retired versus when you were working.
Yep.
And so you shouldn't be penalized for doing good deeds and taking care of yourself and leaving money for your family. So it's very important to definitely plan and know what you're getting yourself into before doing it.
Okay, thank you. No, that's
Right, and just for those that may be, again, not on Zoom, I know that we've been having a little technical difficulties with the Facebook Live. I'm not sure if, if the visual part is freezing as well as the audio, but if the audio is still going, what I typed in the chat box, you guys, for Social Security Administration is ssa.gov. That's the website that you can go on. Again, ssa.gov. I have my clients do this all the time. I spoke to a young lady about that today, about helping her mom with that. If you want to be, again, it's about proper planning, is about being proactive, not reactive, okay? So again, ssa.gov, you create a user ID, password, and then you'll be able to actually see how many work credits that you have to qualify, or if you don't have enough, okay? And there's a mathematical, yep, there's a mathematical formula that's there, that you can kind of go over. And Denisha, again, you guys, and again, listen, Denisha, again, if you feel, or you guys out there listening, if you want us to cover that, when we go into some retirement plan, and we can cover Social Security as well, again, just send us an email. Again, we want to try to tailor make this content to you. Everything that we bring to the Building Black Wealth series is because either something that you asked for, or we saw identifying the need based on the people that we're going out there to help. But I've been running to a lot of people that that are having some concerns about Social Security. You should be concerned. Liz said it. Okay. And there's data out there. They're saying that by 2034, that's right around the corner, 2034, people are going to start to feel the pinch of a drop in Social Security benefits. They're projecting it to be about between 20 and 25% less than what's projected. This is why we're doing these events here, and again, because it's supposed to be supplemental, not the end. However, if it is the end, it's good to find out what it is now. So even if you never put away anything in retirement, that you can reach out to your investment professional, or myself, or Denisha, or anybody at this point, to help you properly plan, so you can not only get into retirement but stay retired. Okay, stay retired.
That's
Go ahead.
right.
okay. I think I know the answer, but I'm asking all of them. My mom is now living with me and no longer in a nursing home. I pay for everything. What can I get reimbursed for? Working remote full-time and helping to care for my mom 12 hours a day, water, electricity, anything?
I remember that.
It will depend. I know that some people who care for their parents also go through an agency and get some type of a stipend. I'm gonna call it a stipend because it's not real pay. And so they'll get money through the state for that. So it's gonna depend on if you do. If you don't, and everything is coming 100% out of your pocket, then that your mom, your dad, if it was both of them, could actually be a dependent. The good thing with a parent is the parent doesn't actually need to live with you neither. You can live in two separate places, but because it's your parent and because you're providing more than half the support, you're able to have that parent as a dependent on your return. For the expenses regarding medical, again, if you qualify for it, one good thing is with the medical, that for those that do get it, what helps them is that the medical expense doesn't just have to be for you. It can be for you and dependents on your return. So if you're paying for health expenses, and your medical expenses, dental expenses, vision expenses, and things like that, and it's for 3, 4, 5 people in a house, then you may, be able to deduct those things and use them as medical expenses. As far as, again, the remote working from home, where you're a W-2 employee, right now they haven't really talked about whether or not they're going to extend any type of benefit deduction credit or anything for these. So unfortunately, I don't have an answer for you right now. We would hope that they do the good thing and add that in there, but as of right now, there's nothing.
Okay. And someone responded in the chat, the PCA program through Mass Health will pay for
Yeah,
personal
see?
care employees or for family members. So
Yep,
look
that's
into
one
the
of the
PCA
programs. So that's very helpful to that the person that asked the question about the mom. That could be very, very helpful.
Yeah, there's a lot of programs out there, and depending on your parents, because I went through this personally, and Liz was right there with me every step of the way when I was going through it with my mom. Okay, just speaking from personal experience with a lot of that, and so sometimes as well becomes a estate planning issue where you may have to also even become a power of attorney or some guardianship. Yeah. That legal paperwork. I mean, again, that's what we had that information with the attorneys last event. Again, you can find that recorded. You can find that recorded segment on our Village Initiative Facebook page. Again, that's recorded, and also I believe there's a link into the email that we sent out to this event. Right down the body of the email, there's a YouTube video of that last month segment that talks about estate planning. So you may want to, when you have proper documentation. I mean, Liz, again, you can correct me if I'm wrong. Part of these loopholes is proper documentation. And a lot of times we just don't
100%.
Right?
100%. Because if you're ever asked, it's what you can prove.
Correct.
And the minute you can't prove that, they'll just disallow everything. So yeah, you gotta have proper documentation.
Yep. Proper documentation. So again, you got to be able to, you can't say, oh, well, they spent on my paycheck. See, that's vague. You got to be able to prove it, right? So sometimes you have to go through those channels. That's why we bring the professionals here. So definitely make sure you look at that video, just to see, learn about a little bit more about that content, but also too, depending on the ailment of your loved one. Usually they're already working with the doctor. You can contact their doctor and ask them, hey, can I get some services? Can I get some help? They'll be able to walk you through all of that. Then you contact your taxation professional and then figure out how you can deduct all that stuff too. Listen, I called Liz and I was like, listen, I got 4 god kids. You got to figure this out. I didn't know the loophole because I'm cutting checks for all these kids too, right? Liz like, yeah, do this, that, and the other. So there's always a way, right? It's all about documentation. Okay?
That's right.
All right, Denisha, thank you.
Okay, let's see. I'm looking. Can I rent my house from my business or rent my car? And what's the best strategy?
That depends on the type of business, and those expenses are expenses that are typically going to need some type of income to offset them. So that in order to give a specific, I would need need to ask more questions. So you all can feel, I do want to add that I do 15 to 30 minute free consultations. You want to pick my brain, and you have specifics, and that you can definitely give my office a call, set up that appointment, and I can walk you through or just give you more specific tips for you, what you have going on, or even some ideas for you to just think differently and start to think differently so that you can change up what you're currently doing to, get a different outcome if that's what you're expecting.
Yeah, and that's awesome, Liz. We appreciate you offering, again, you guys, 15 minutes to 30-minute consultation. The best way to kind of maximize your time with her, right? Have all your questions. You can squeeze them all in that time frame.
Yep.
Yeah, right.
No, it's true.
Yeah,
Proper
so make sure you got some clarity. You can't with the arms, I'm not really sure. No, maximize that 15 to 30-minute free consultation with her, to get that info, whether you decide to use her or not. Again, she knows that some of you out here may have a tax professional that you're working with. She's not that naive, right? But if you don't, and you want to see if she's a fit for you, that would be a great time for you to be able to assess that. Also, besides of what's been happening here. But that's great. Thank you so much, Liz. But
Absolutely.
Yes. Okay. So this, I'm not too sure of the question, so the person's still on, please just rewrite it for me or raise your hand. Is it possible to donate my taxes to the community and set up some fund through my Social Security for the community?
You can, but usually that would be done through a trust.
Okay.
Yeah, and so that would be an attorney that would go in with estate planning. So contact an attorney would be able to help with that.
Okay. And then this one, they're asking for tax strategies in terms of your business formation. So LLC versus S Corp. You said you're going to send out like a sheet on that, right?
Yep,
So
I'll
I think that
send a
might be
sheet,
better.
and that will be better because, again, I can be here all day and night.
Mm-hmm.
You can use them just because I said, Denisha, you should be an S Corp, and Michelle, you should be an S Corp. It doesn't mean it's for the same purpose, and we're going to use it the same way. So yeah, so it's getting a general idea on how they're treated differently, and first off, knowing whether or not you want it to be completely separate from your private, your individual, or you don't mind it being connected to you a little bit. Is going to actually be the first step to figuring out what exactly that would be the best entity for you.
Okay. And then is a vehicle or a depreciable asset required to be straight line, depreciated, or doubled?
It can be doubled. Those are one of a vehicle could be treated as what we call it a Section 179. You can expense the whole thing the year you bought it, depending on when you bought it, what during the year, what quarter you bought it in, and the cost of it and your income.
Okay.
Great question. That was a good one.
I know. Okay, so should you get, and I've heard this before, should you get a refund when you file your taxes? Is that a good thing or is it a bad thing that you're getting a refund?
It's only a good thing if the refund is contributed to credits. If it's all of your money, then no. Why did you give the government interest-free loan? Why didn't you put that money somewhere else for it to work for you? Unless I do have people they use that for savings because they have no option, or they don't have what do you call it? They don't have the willpower to save on their own. So they will over withhold on their taxes so that once they file their taxes, they get this huge refund. So now they're paying their car insurance for the year. They're going on vacation. They're doing it as a saving strategy that works for them. So I wouldn't put a downer on it to say no one should be doing it. It depends on why they're doing it. Again, everybody's different, and so I wouldn't say it's a good thing, but again, if that's the only way someone can save to get things done, go for it.
Right. And just to tighten up just a quick minute too. So when Liz said that if only those refunds in terms of credits and not deductions, if she's saying your money, what she means is that when you get get hired onto your job and you get your pay stub, on your pay stub you have something that's called your exemptions or your
withholdings.
What is it? Yeah, your withholdings. So it shows like state and federal, and it shows either your S for single or M for married, and you either claim 0 or 9 or 5. That's what she means, okay? By that, that's your money. That's your money. So if you're getting large refunds back because your exemptions are off, that's, she's saying, again, depending on, that could either be a no, or yes, depending on your situation. Better, again, we all about leveling it up, right? Better is to have it be done through a credit, but you may not know what that credit is unless you're working with a taxation professional. Okay, so that's why you got to work with somebody so they can tell you the difference and help you maximize that.
Right, and that's the next question. What are other tax credits that people should be aware of? I don't know if that's too exhaustive of a list to go over now.
It is
like a handout.
I mean, the main ones are the ones we discussed would be the savers, the child dependent care credit, the child tax credit, but a lot of the credits, they just it's so many. You got a home energy credit. It just really depends on the person. So there are a lot of credits, people, a lot of credits and deductions, both business and personal, that's out there. But again, um it just depends. It depends on you and your situation and what you have going on.
Okay.
Right.
Is there a
Definitely
list?
use that 15 to 30 minutes consult
Right.
that she offered, okay? So if you, again, you want to get your things, again, even though we're talking about general things and some you're asking questions specific to you, you really want to deep dive and have her answer, just with that one-on-one time with you, reach out to her so you can get that 15 to 30 minute free consult to get that answer.
I think I have two more. So we did that one. Would you say it's beneficial, with respect to taxes, to have a child, um, if you're a single W-2 filer? I think that's how they meant to ask that question.
Is it better to have, say that again?
Uh, the exact question, would you say it's beneficial tax-wise to have a child than not for a single W-2 filer? So it's better to have children if you're W-2 from a tax perspective.
I guess the question I'm asking is, if you have a child, why wouldn't you be claiming the child? If
Right.
you're asking to see if you have a mate and you're not married, and so you filed separate tax returns, so you're trying to figure out who would be best to claim the child, there's a way that both of you could use the child without claiming the same deductions, because you can't do that. I do that a lot with couples that aren't married yet. One would do head of household because they get the bigger standard deduction. The other one would claim the child as single and get the child tax credit, vice versa. Like we can get real creative with it. Hopefully that answers your question. But if you have a child, I'm not sure why you would not want to claim that child to get that deduction.
Okay.
I love that word. She gets real creative. Again, that's what this is
Yeah.
all about. Creative taxation strategies, you
Right?
guys. I love it.
I love it.
This is the difference between a tax preparer versus a specialist like Liz, a taxation
Yes,
strategist. There's a big
exactly.
difference, you guys.
Yep. Try my best to understand the question. Why do the local, state, and federal, let's see, I guess, why are we paying taxes to them, and where does it go? That's what I'm gathering from the question.
It goes all over. We have to pay taxes. It is what it is. We have people that is in the government. It creates jobs. You have people that work for the state. You got people that work for the city. It needs to be maintained. So it's what allows us to have. Otherwise, if we go on being selfish, not paying for anything and just for our needs, then the street that you're driving on, nothing. You have a problem with utilities. How about you won't have any utilities?
Right.
So we got to pay taxes because it just helps our economy. It's just something that we have to do. And so that's what I tell a lot of people. The goal is not to not pay it. You pay what you need to pay. You just don't overpay it. That's it. It's something that you just got to do. It's almost like getting up in the morning and brushing your teeth. Something you just got to do, unless you don't want any teeth.
Yeah. So I guess this is one, let me see. This will be my question, pseudo question. So when you're thinking of someone who's a W-2 employee versus a business owner, or when you're thinking of the wealthy, kind of how do the wealthy navigate things so that they sometimes are paying, they're millionaires and paying less taxes than people who are, making under 100,000, for example.
Their income is not W-2 income.
That's
So
just
if
how
you look at the tax schedules, take a look at the tax schedules with regular ordinary income. So any income that you earn that is considered ordinary would be W-2, self-employed, rental income, all those, even retirement income is ordinary regular income. And I showed you on the earlier slides what the tax rates were depending on where your total income um, fell, where you have cap gains. Most of the rich and famous, they have investment income. They
Yes.
have invested this money, and the cap gain tax is low.
Way
It
low. Right.
it's based, the max you're gonna pay is 20%. The schedule I showed you, you would see that it's close to 40% the most with the same money. So yes, when you see Mitt Romney and they said he didn't pay anything, or they talking about Trump and things like
Yes.
that, that's
Yep.
because they have a mixture of things, and not all their money is W-2 income or rental income. They have a decent portfolio that where one, you have one thing, then you have the other one to offset it, to
Yep.
put you in so that you're not overpaying.
So they
Multiple
actually
streams
track.
of
Yep.
income.
Right. Right.
Yeah.
Multiple streams of income.
Okay. I think that's everything because a few of them are more related to, I think people are really concerned with because they had to work from home and telework, if they could write things
Yeah,
off.
because those expenses increase. They have every right to, and I'm with you all. I am hoping that they do something to help offset those costs, knowing that everything, everything went up, your utilities, things that you had to purchase that normally the job would. But I'm gonna say, try to think outside of that and see what you can do to offset that yourself, because one of the deductions that they had forever and disappeared, Trump got rid of it in 18, was the miscellaneous deductions for non-reimbursable expenses from your job. You already had to be able to itemize your deduction to get this deduction, but they even took that off. So those that are nurses who have to wear uniforms, those that have to pay union dues or pay for their own tools, they already took that away in 2018. So I'm not real positive that they are going to do something about this, even though people were forced to work from home and had those extra expenses. Look at it, let it be a bonus for you if they do. I would still try to become creative and think about other ways that you can use any type of deductions or credits, or do something differently to offset that cost.
Question. So if you were to start an LLC or a business now, how much of it could you write off for 2020? So let's
Uh,
say you've been teleworking, you have to go buy the computer, you have to go do all these things. You're a W-2 employee. Could you start an LLC to offset those costs and make that a write-off, or no? How
you
would that
could.
work?
Some could and some couldn't, depending on what type of business it was that you were starting. So that's a really good question. Absolutely.
Okay. So guys,
Absolutely.
definitely I say utilize your time to really think of, plan ahead, plan as if the government's not going to help you, and
Absolutely.
figure
Let it be
out
a bonus.
and figure out, what business could you start or do so that you can offset some of these costs. So this is when we talk about what the rich do. This is what they do. They spend the time trying to figure out how not to pay so much in taxes, and that's what you're utilizing this time for. So let me see. Oh, hey, what just happened? I think that's everything. Yep, those are all the
Yeah.
questions. Because everything else, they're kind of similar.
Well, good. Again, I thank you all for the opportunity. I always am open to sharing information. You got to. It's no good if you just have it and have it for yourself. You have to pay it forward. It's the only way that we all can get ahead. I'll tell you that majority of my clients that are doing really well, they didn't start off alone. They started off together. They may have ventured out and done their own thing, but they always started together. They were very open with each other and sharing with each other. And in order for us to do better and be better, we have to do this together. We have to do it together. And
Right.
so, again, I thank you all. I will send, Denisha, I'll send that to you in the morning. I'll send you the, for the breakdown for the different type of entities. I will tell you all, if you wanted to, you could send your registered information. I do have, or you can visit my website, www.emjfinancialservices.com. There is a free ebook there. You also can add yourself to my email list. And that email list, I send out tax tips, strategies all the time. I send out both a business version as well as an individual. I don't want to leave anybody out.
Yep.
So I make sure there is on my Facebook page, if you like my page, there is a post every single day on Facebook relating to what's going on now and how it may or may not apply to you. So again, even if we're not doing business together, I'm all about sharing the information. And so you're welcome to, again, sign on to my, go onto my website and register yourself, or you can send me your information and I'll add you. And you can definitely visit Facebook. Facebook is where I have most of the activity. I'm on Twitter, I'm on Instagram, and some of them will post, but not as much as you would get on Facebook.
Yep. Awesome.
Awesome.
So
Thank you so much, Liz, for your
Very
time.
welcome.
You didn't have to, and we truly appreciate it. You dropped so many gems, so many gems. We really do appreciate it, and taking the time to answer all of these questions that people had. I hope, for those of you who are still listening, that you take advantage of this and really begin to plan and strategize from a tax perspective on, what you want your future to look like. Even if there are things you can't change from the past, even though Liz said you can go back 3 years on your taxes, so that's still an option. You can plan for the future and correct the mistakes of the past. Like I plan to. I'm restructuring a lot of things right now. So I think it's imperative, given everything that's happening now, that we kind of put a pause on our busy lives and try to figure out how to structure things moving forward, so that, God forbid, something like this happens again, or this is prolonged, we're better equipped moving forward.
That's right. That's right.
Thank you so much, Liz.
You are very, very welcome. Thank you so much, ladies. Thank you, Britt, for
Liz.
managing that. Thank you, Michelle.
You are very welcome. Yeah, that's my pleasure. No, the thanks is all ours, and thank you everybody for hanging in there, being on there tonight, and supporting us again. You know that Denisha, myself, and Britt, we are nothing without the support of you guys. Okay, this is why we always show up, and when we show up, we grow up and we glow up through this, right? And like Liz talked about earlier with the business owners, again, what she was saying is that not to competing, we collaborate. This is what collaboration looks like. We need to get more collaboration and less competition, okay? And then so the whole idea is that we want to continue to be able to lift up everybody. So please, even if there are some things that did not apply to you, again, it's not about you, it's all about all of us. We need to get back to that communal type living like our ancestors did. We were communal people, okay? So we gotta each one teach one. We gotta pay it forward. You guys know I'm a big proponent, for that, okay? So if things didn't apply to you, still you pay it forward to your parents, your aunts, your uncles, your friends, your significant others, everybody as much as possible. Please definitely, again, feel free to reach out to Elizabeth. Take advantage of that 15 to 30-minute consultation. Liz, if you can just, again, one more time, drop your website, drop your Facebook account, because we did have it up on the page and it jumped off a little bit. So I want you guys to get that, but also stay in contact with us. So, okay, if you need it, Liz's info, but what she's going to do is to be able to verbally just give you quickly what her Facebook page is, because that's what she communicates the most. So Elizabeth, if you can just just really quickly, and I believe Liz had put it in the chat box. So right there in the chat box, everybody, facebook.com/ I believe it's EMJ Financial.
Yep.
Financial. Okay.
Yep.
So
Facebook.com/ EMJ Financial, and the website is www.emjfinancialservices.com. financialservices.com.
Again,
And I'm gonna put my phone number up because if you want an appointment right now, my schedule is a little wacky, so it's definitely gonna be best that you call the office and have one of the ladies help you set up an appointment.
yes, her assistants are great. The only way to get to Liz is through her assistant. I'm telling you, Liz and I have been friends for a long time, and I fall in line, okay? I call the assistant. Listen, I know where she lives and got her cell phone number, but I still follow protocol, right? And I call the assistant, right? You know what I'm saying? Because listen, Elizabeth she's a taxation strategist. I mean, she's busy from January to January. She just doesn't show up during April during tax time. She's busy all throughout the year.
All
Okay,
throughout the year.
so please be mindful of that. She will get back to you if you call once. And again, she doesn't need you. You may need her. If you call again, okay, call again if you don't read anybody. Again, she's getting a handle on her schedule through the COVID. So even if you called once and nobody picked up or whatever, I kind of highly doubt that. But call again, okay? Please take advantage of that. Again, knowledge is not power; it's applied knowledge. Please apply the knowledge that she shared with you this evening. And also, we look forward to seeing you guys again at our next event. You can feel free to check out all the archived videos that we've had throughout the year, last year and the year before, on our Village Initiative's Facebook page. Okay, please definitely like and subscribe to the page. Again, our Village Initiative Facebook page, so that way you can see all of our archived videos that we've had in the past. The other thing too is that email that was sent out to everybody that's on the mailing list. Again, Denisha, you can type in your email in the chat box if you want to get on the mailing list and get that email, because maybe you've somebody invited you to here and you didn't get the email that talked about the attorneys. Okay, I know someone had asked about the YouTube channel, and also Denisha, if you can pop in there about the YouTube channel where they can see that the archive video from some of the attorneys that we had, which were fantastic. So definitely, again, guys, stay in contact with us. You can also pre-register for the next event. We say put them all in your calendar. There's a flyer that's out there for the rest of the whole series. Some of the topics may change. Please be flexible and understand the topics may change. We're all in this. Listen, we may be separated, but we're all going to this together, okay? The topics may change, but the dates will remain the same unless there's something, wonky. But the next event that we have coming up, again, you go to Eventbrite website, and then you can type in Building Black Wealth. Because we're so highly popular, yes, we are. That's the first thing that comes up, okay? That's the first. It is. It's the first thing that comes up. We listen. We bust our butt to bring you guys content, but we also know we're nothing without you guys. That's why we do this. Okay, so go to eventbrite.com. And you type in Building Black Wealth. The series is the first one that comes up that we partner with RCC, and you can go in and you can take a look at the flyer that talks about all the topics. Pre-register, pop it in your calendar, so that way you already have all the rest of the series that are already in there, so you're not scrambling around looking for it. Again, even that part is our proactive planning. So thanks again, everybody. Your questions were awesome. You guys were on top of it. I love those questions. You guys are on point. You guys know that we're all here about building Black wealth. Ain't nothing about living us hand to mouth and surviving. It is whatever is necessary for us to build wealth and to hold on to it. Pay less for taxes and to pay it forward to the next generation, right? So we want to thank everybody definitely for your time, your patience, your love, and your support. Please stay healthy. Please stay safe until we see you the next time. Thank you again.
Thank you.
Thanks. Bye, guys. Thanks.